It is that time of the year. Your company is offering you a whole ton of benefits. You have to decide which ones you're going to have and which ones you're not going to have. We're going to give you the best options. Here we go. Welcome back to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host, as always, is Heather Townsend. We are talking about your benefits enrollment period because it's that time of the year. We're going to take you through everything. We're going to give you the pros, the cons, the good and the bad, and we're going to tell you what you should be looking out for and what not to look out for. If you haven't been to our podcast before, we split it up into a number of sections. We talk about content in a deep dive. We ask and answer questions, and then you get to know about each of us personally. So sit back, enjoy, and let's go. Heather, lead us into that first segment like you always love to do. What's it called?
Let's dive in. Dave and I, when our clients who are in corporate America, have employers, get their benefits enrollment packet, hopefully it's a nice, beautiful PDF. I love when companies do that, don't you, Dave? Where it's like just this beautiful put together PDF that your clients can send you and it just outlines everything. Yeah. I comb through, and I'm sure you do too, these benefits enrollment packets because there can be some goodies in there and we can save our clients money. It's important that this can be material for clients, right?
Yeah. What's the first thing you look at?
Health insurance right away. You?
Yeah. That's the big thing that people spend money on and can make big changes to as well.
Mm-hmm. If my clients are healthy, right? Not going to the doctor very often, I normally go, this will surprise you, but the higher deductible plan. In general, if my clients are healthy, 20s, 30s, 40s, they're not going to the doctor very often, they have an emergency savings. It's almost worth the risk, right? Because if you lock in normally a lower deductible, right? You have to spend, let's say, only $500 before insurance will come in and start covering bills, right? That would I would consider a low deductible health plan, right? A high deductible health plan might be like $3,000, $4,000 of a deductible before they'll cover anything. You have to spend $3,000, $4,000. Sure. Granted, normally preventative, this is getting a little into the weeds, but preventative things like your medical checkup, your exam, those are normally included and don't count towards your deductible. But I will digress. Point being is my clients have emergency reserves and cash, but that premium, you are locked in, that higher premium. A lower deductible comes with a higher premium, and you are going to pay that regardless, right? If it's $200 a month, you are going to pay that if you enroll in that. Whereas if you don't have a health event and you get the $100 health plan, let's say $100 a month health plan, if you don't have a health event, you saved.
From someone who's had a kid go to the hospital every single year, I would love to be in this type of health plan. It breaks the bank every year. So I'm waiting for the day.
That's why you need to get an HSA, Dave, which I'm going to convince you in the next episode. But also, like, you have boys, right? Like, I also think there's statistically something about boys probably go to the emergency room than my household with girls. I don't want to jinx it, but
yeah, good luck.
I just think statistically that's probably likely, right?
Boys in violent sports? Heck yeah.
Then I go into the tax savings, right? Does an HSA, does an FSA make sense? I do not hide my feelings about things. I am not a fan of the FSA. I don't like this whole idea of you lose what you don't use by the end of the year. Like, it doesn't roll over. Mm-hmm. Like, I love that you get the tax deduction, you get to put money away, but if you don't use it all or someone forgets, it doesn't roll over. I don't like that.
Yes, I agree. I think that is the big benefit. Even though an HSA is more to the healthcare, it's an investment account too. The FSA is pretty much, they're taking you hostage. Like, you're going to use this. We might give you a grace period at the end, but if you don't use it and nothing bad or planned happens to you that you can use the money, it's gone. I'm not a fan either.
Let's say you do have a prescription, though, that you need that is very expensive and it costs you $200, $300 a month. There is not an HSA option with your employer's benefits. Then I probably would do the FSA for that client and put just what you are going to spend for that year so you don't lose any money.
Sure.
Because it's pre-tax. My ideal, though, most of my clients, I will say, are in high deductible health plans. You are required to be in those if you want to be in an HSA, because many of my clients' employers also put money in clients' HSAs for them. So I do the math and it works out. This is for healthy clients. In health insurance plans, I would compare the plans, the premiums, the deductibles, the out-of-pocket maxes, and I would consider either an FSA or HSA.
All right, let's get you off this HSA train. Come on.
Let's just wait till the next episode. All right. The other one, which I also take part in through my husband's employer, dependent care FSA. So anytime you hear FSA, flexible spending account, it does not roll over year. So you lose what you don't use every year. But if you have kids in childcare like I do, they are in preschool, I can put money aside from my husband's paycheck pre-tax to pay for childcare. Now, my husband only gets $2,000. I wish it was a little higher, but hey, I'll take any tax savings I can. And then at the end of the year, I give this little form and get reimbursed from the dependent care FSA to help pay for childcare.
I think that's the big thing with an FSA. If you know those costs are coming up, childcare, therapy, any type of therapy that you can pay for through an FSA, throw the money in there first. Yes. And then submit the receipts, get the reimbursement, or spend it with the FSA card that you might have. It's really hard to do it with expenses that may come up. If you know they're coming, use the FSA.
Okay.
I'm taking us into the next one. We're done with these. All right, disability insurance. So you got multiple types. You got short-term and you got long-term. Short-term is usually given to you by your company most of the time. Sometimes you may have to buy it. Long-term disability is a variable that a lot of employers give, some don't, and they can choose and design it how they want it to be. There's usually state maximums with disability insurance, so they can't give you 100% of your paycheck as a disability up until the age of 65. That doesn't exist. They may give you 50 to 75%. If you are highly paid, you're going to get capped out. So it's typically going to be 50 to 70% of your income up to a cap of $10,000 a month. Before I keep going, Heather, you have anything to add there? Because that was a lot.
It's interesting. I read the fine print, like how long is that long-term covering? I've seen some employers limit it to like 24 months. Have you seen that before?
Not that stringent, but there are some caps depending on someone's position in a company. Mm-hmm. They will, sometimes it's not that specific, but depending on the industry too, if they know they've got highly paid employees, they will make it a much more rigid disability plan because they'll be on the hook for a lot of money.
Like up to $10,000, something like that. Like I'll see a cap like that, right? Like we'll only pay for this duration up to this much. And that's where you got to consider, do I need an outside policy or do they offer the buy-up option, which I think you're going to discuss.
Yeah. So example, let's say you make $20,000 a month. If your long-term disability policy caps out at $10,000 a month, you've obviously got a hole there of $10,000 of your income's missing. You can't insure that extra $10,000 because that goes over state limits. But you've got two options. One, you can, if they offer it, your employer might offer a buy-up plan where you can buy an additional long-term disability policy on top of what you already have, and that gives you the max benefit. If they don't, you should probably go out and buy a personal policy which gets you up to that state maximum. The nice thing is you can then take that, should you then leave the company, that's your policy for life. Like you don't give that up every time you leave a job, which you do when you leave a job and you have all the benefits through your work. All right, life insurance. I love work life insurance if it is portable, which means you can take it with you when you leave. That's an important distinction to make when you're looking at your benefits. Because if you buy a whole bunch of life insurance and then you're 10 years older and you leave a job and now you have to find more life insurance, it's going to be more expensive. So it's not a great benefit once you leave the job and leave the life insurance there. Yeah.
How have you seen if it's portable or not? Where do you have to go into those details? Because I found that's hard to find on life insurance.
So most of the time it's not obvious.
Yes.
But if we are planning to buy a lot of the company, I'm going to have them reach out to HR and the benefits division and ask that specific question. Like, can I take this with me when I leave?
Is it
or portable? I'm going to ask them to use the words, Is it portable? Can I transfer it to my own name out the company's name? Those specific things. HR will know what they're talking about because they're benefit specialists. If you get the right person. But most of the time they know what the answer is going to be.
I just wanted our listeners to hear that. Thank you, Dave. All right, keep going on your life insurance. You get so excited about disability and life insurance. Who would have known? Woo!
I love it. So life insurance, I'm buying as much as I can at work if I can take it with me. If not, I'm taking the free amount. The reason
it's normally
being,
like 50,000, by the way.
It's 50K, yeah. The reason being, if you dig into the weeds on life insurance, your premium does change over time. You might not realize this, but let's say you're a company for 20 years, your life insurance premium from day one all the way through to year 19 actually goes up. It can get more expensive in year 19 than it would be if you had purchased your own policy 19 years ago. That
I did not
required a project of analysis, and that was a pain when I did that a number of years ago. So take the free insurance that work gets. If you're young and you're healthy, buy your own life insurance outside of work for as much as you can get.
Term, not whole life or variable. Run.
Term for 30 years. That's what you need.
Or 20.
No, 30, sorry.
What if they're 35?
Okay, moving on. Okay. All right. You're going to get pitched accidental death and disability on you, your wife, your children, business accidental death and disability. Decline all of them. They're cheap, but the chances that these will pay out are so small. And it's accidental death and sometimes dismemberment.
I know. I think that dismemberment, like in your office job, what are the chances? I don't want to jinx anyone, but like I'm not out as on a line. You know what I'm trying to say? What did they used to have where it was dangerous? What is the term? Dave,
I have no idea what you're talking about.
Assembly line, like assembly line at factories. Like that was back in the day, that could have been a concern, right?
I've worked on an assembly line. Worked on two. This was back in the day in England. I worked on a cake packing factory line. We put cakes into boxes. And I lasted 2 weeks in that because then they asked me to work overnight. And I was like, no. And then Toyota car doors. I delivered all the parts to the assembly line. I was probably like 20 when I did that. Yeah.
Were you at risk? Okay, I just learned something new. How was working on an assembly line? Did you want to just...
Absolutely terrible. I wanted to poke my eyes out every single day. That's why I lasted 2 weeks at one and 7 days at another.
Yeah, same thing over and over and over, right? Not much excitement.
Yeah. Now, if you're on an assembly line, sure, you may get your arm cut off if you do something stupid. If you're sat in a cubicle at work, what are the chances of your arm getting cut off from a keyboard mistake? Keep the $4 that you're going to pay for that insurance because your chances are so small.
You get accidental death? Like, how do you define that?
Joey threw a stapler across the office and it landed straight in my temple. That was an accident on my part. It had nothing to do with it. But yeah, it's just dumb.
And like, if you have life insurance, why do you need AD&D? It's like duplicative, but AD&D is like life insurance covers this much, and then AD&D is like, why? Why bother? Just get life insurance. Call it a day. Disability, life insurance, skip AD&D.
Yeah, move on. Right.
Okay. This one's yours.
Okay, let's move on to deferred comp. You're looking at how much of your income you're going to put into savings in the company next year. So if you're in 2025 and let's say you earn $100,000, we're using round math here, and you want to defer $20,000 over the course of your paychecks for the next year, you have to make that decision now. You can't do it next year because it has to go through processing. So good luck. Try and project what you're going to need next year. This typically works for people who are highly paid. And if they have excess, if they've maxed out 401ks, they've got extra savings in other savings accounts, and they still have excess, and they need the tax break too, because deferred comp is a tax-deferred benefit, then that's when I encourage them to do a deferred comp election and defer some of that income.
This must be big in the pharmacy world, because I have not seen deferred comp in my clients' benefits enrollment. It's interesting.
It's huge. Yeah.
Yeah.
I mean, because they can defer income, they can defer base salary and bonus, do an election on that. And some of the people who are paid very well, they're deferring like 30 to 40% of their income across the board.
It's amazing.
Which has its own problems, because when you're doing deferred comp, you also have to say, okay, out of this amount that I'm deferring next year, when do I want that paid out? And the big mistake you can make is a year from now, because you can start it from 1 year all the way up to retirement and then spread it out 15 years to retirement. Well, if you get it paid out a year from now, you're just deferring income in a high tax bracket to get it paid out in a high tax bracket. It didn't work. You want to make this a payout in retirement when your tax bracket's a lot lower. You also want to spread this out over a period of time so you can create an income plan in retirement for money that you never even saw. And it keeps you in a low tax bracket too.
Yeah, I have retirees who deferred and then they came to me and I'm dealing with the defer date.
So the last thing to do with your deferred comp, invest it aggressively. If you're deferring it and you're age 50 and you're looking at the age of 65 when you retire, you've obviously got 15 years of investments to kind of weather the storm. So invest it aggressively, let that money grow, and then your payouts will be bigger.
I don't know if you have a lot of clients, but I look for this. If my clients need to get their estate documents done, I look and see if there is a legal benefit, like Hyatt Legal, or I think they're like MetLife Legal was another name. It's like, I don't know, $10 or $20 a month. And they get a list of estate attorneys in their area that they pick from, and they get their estate documents done basically for free. I mean, not free, you pay the premium, but let's say you pay $200 a year versus that $3,000 or $4,000 you would if you just went to the lawyer directly, right? Yeah. It helps me get my clients to get their estate documents done too, because it's cheaper and they have a deadline, because I'm like, well, you enrolled in it this year, so you have till November, December to make sure that the estate documents are done so we can unenroll, or you got to pay for it again the next year. But I do look for that for my clients that need to get estate documents.
Do you take a look at the attorneys first on the list?
I don't. I think if my clients are needing complex estate documents, yes. But I don't know, that $2,500 discount is really hard to turn down. And I haven't been upset with the attorneys that have come out of those.
Yeah, you just need one good one on the list, and it makes the benefit worthwhile.
Mm-hmm. And then I also check like employer benefits or discounts. I don't know, sometimes they have weird like, hey, if you do X, Y, and Z, we will discount your health insurance premiums every year. Or if you belong to this gym or want to enroll in this gym, or you get a rental car through this, like I note those things knowing my clients and how they live. And I'm like, you might like a few of these, right?
This one wasn't needed, but it kind of popped out the page of one employee benefits I was looking at recently. Adoption and IVF payments. That was up to $75,000 in IVF benefits per individual. It was huge. And then they would do 2 rounds of adoption. So I'm like, that's like 25 grand right there if you're looking at the tax deduction and then you get the benefit from your employer. Like, these numbers are massive.
That is amazing of the employer. That's really awesome. And in the bow, health insurance plans look at dental and vision, meh. There's normally one option. I don't get too excited about them. HSA, Heather prefers over FSAs. Disability, definitely pay attention to long term. If you have deferred comp, Dave already put that in a bow. And if you need to get your estate documents written, enroll in the legal benefit option if they have that, and review the employer discounts. How was that?
Perfect.
Thanks.
All right, before we move on to our next segment, you might need to do something. If this is your first episode with us, you don't have to do anything. Just sit back, relax, and see if you even want to come back to another episode. Don't insult us, you do. But if this is not your first episode, you need to leave us a like, a comment, a follow, subscribe to any channel that you're watching this on, share it with someone. Just do one of those things. We just like to know that people are there and that we're interacting with people and we're not just talking into the abyss. So thank you. We're going into our next segment. It is called What Would You Do? What would you do are questions that are related to the material we just went through, just in case that's your preferred learning style.
I have a long list of benefits available through my employer. How do I choose which ones to pay for? We just did that. We put that in the bow.
We did. I do find that people get overwhelmed, though. They're like, I have 15 benefits here. Yeah, which ones do I do? Like the essential ones. Mm-hmm. Like what happens if you are dead or disabled or you need some healthcare? Like those are the ones that are really going to be essential for you and are going to be the ones that you're going to save a lot of money on by making the right choice.
Start there.
The fancy outliers, probably not going to do much of a benefit for you. So,
and when you're looking at and I should have said, when you look at health insurance, pay attention. I pay really close attention to deductible and out-of-pocket max, because deductible is what the health insurance is going to cover or is not going to cover. You have to pay completely out of pocket before they will cover anything. And out-of-pocket max is how much you have to spend out of pocket before health insurance will cover everything.
Question number 2. My job has just instituted a long-term disability buyout policy. What is this and should I enroll?
This should be your answer, but...
You want me to keep going?
No, but I would say if what the employer covers, let's just say 60% of your income up to, let's say 10,000, and you are really taking home 20 and you need that full 20 for your living expenses, then yes, you should consider it. If the employer long-term disability just base does not cover enough of your income, you should consider buyout.
All right, question number 3. What if my spouse also has employer coverage? Can we both enroll each other? I see that look in your eye.
Well, because I had a client do this. All right, some backstory is this client, their spouse had a huge health event. They almost lost their spouse from a health event without disclosing. Mm-hmm. They actually duplicated health insurance enrollment. And what I mean is both work at different companies. Spouse, both of them are enrolled in company 1 health insurance, and then other spouse is enrolled, both spouses, in their company's insurance. So they have 2 health insurances. They did, let's say. Mm-hmm. I won't get into the legality of that, because I think when you and I discussed this, we were like, is that a legal issue? That could be a legal issue. I'm not a lawyer. I don't know. But when I explained to the client, I was like, hey, but pretend Sally, that means you have to hit 2 deductibles and 2 out-of-pockets. Like, you want to work towards 1. You are double paying insurance. This does not make sense. We need to get you the best policy that covers what you and your husband need. We do not need to be duplicating health insurance. Mm-hmm. But it's amazing what people do out of fear, right? People react. Money, fear is much of our job, right? Is kind of talking people off the ledge and not letting them make emotional decisions. This was purely out of emotional. I completely get it. Now we have 1 and 1. So it's fine. They're on their own companies and the spouses are not that. But no, do not do that. I would compare them though. Should you and your spouse be on 1 health insurance, or does it make sense that you just have your own individuals at the company?
This actually gets a little tricky if you get into the situation when you need to claim. We actually went through this past summer of my son got hit by a car when he was on his bike. And when you start to claim things on insurance, they will start to ask, are you planning on claiming on any other insurance for these expenses? So if your client had got into that situation, they're on 2 insurances. Now these insurance companies can pit against each other and say, well, we're not covering that. You cover that. No, I don't. You were, it should be covered under you. It should not be covered under. That just makes a messy game there. Even though you're trying to do something where you get more benefits, it may just not work. All right, let's go into the final section of our podcast. It's called Highlights. This is where you get to learn about us personally, whether we share something personal or professional. It's up to us. So I'm going first. I'm really jamming with Netflix right now. I go in waves. And I'll tell you why. Love is Blind US season 9 came out.
Oh dear.
Oh, it's a train wreck. Oh, it's beautiful. I mean, I am a psychologist at heart. That's my undergraduate degree. I love watching social experiments happen in real time and seeing people like lie to themselves, lie to other people, do things just to get a benefit out of. It was wonderful to watch this train wreck happen. And then after I watched all those seasons that were released, then I was watching this show called Boots. It's about this kid who is a closet homosexual, join the Marine Corps because he just didn't have any other way to go. And it's actually like a lighthearted show, but it's really well done. So I edit this podcast, so I appreciate all the editing that goes into these shows, and it makes it a much better show to watch.
I might want to watch Boots. I like that. That's cool.
Mm-hmm.
Love is Blind, no. Well, I'm going to do it. Dave, do you want to just tell the listeners what I'm doing right now?
She has a spinny chair. She's in her new office on a spinny chair.
I'm in my house. We moved in this weekend. It's almost done. I'm so
how long
excited.
Has it been?
4.5 months.
How long did you think it was going to take?
2, maybe 3. But okay, to be fair of my contractor, he was like, I'm going to hope for 2, but I want you to plan for 4. So he was actually pretty close. I really respected. He did a great job. On social media, I did a fun little poll, which I don't know if our listeners remember, but everyone said it was going to take 6 months or a year. That was the majority. Ha, 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 ha,
okay.
ha, 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 ha. So I feel like I won a little bit, right? I mean, we're still like, some cabinets still have to be finished to push to close, but it is amazing. It is better than I expected. I actually teared up walking in. I just can't believe it's my house. It's amazing. And so this is my new home office.
New office. Love it. It's nice having that contrasting background when you've got like a light colored shirt and light hair. Grandma's wall just wasn't doing it. Bless her for giving you a place to live, but it just wasn't doing it.
No, it was not very Heather-esque.
Well, thank you for listening to this episode of Playbook of the Wealthy. If you're listening and you just want audio, you can do it on whatever audio platform you listen to. If you want video, Heather's going to kill me if I don't say Spotify, but there is a video on Spotify. You can also watch on YouTube, Instagram, and LinkedIn. I try to say them both at the same time. If you want to send an email to the show, you can. You can email us at hello@playbookotw.com, and we will see you next time.
Don't forget to review your benefits enrollment. Toodles!
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.